Welcome to the Harmonic Trader Monthly Program. My name is Jonas Hunter, and I'm here with Scott Carney, creator of the Harmonic Trading Approach. We've examined a variety of markets from the perspective of harmonic trading and review Scott's topics that he has addressed in his monthly report. You can access a free trial to Scott's monthly report at his website, harmonictrader.com. Now let's get started and see what Scott's looking at this month. Scott, how are you doing, and what's happening in the market today?
Hey, Jonas, thanks for the great introduction. Great to be back with you, and this is our second program. Happy to get this whole podcast program started on a monthly basis, and every month I write a report. Been doing this for nearly 15 years, where I cover a variety of financial markets, and so we're going to use this program to review that report and look at other markets that are pretty relevant and pretty pertinent for the next few weeks. So we're looking at a variety of different situations. There's some things we discussed in the last month's report that I think we'll follow up on and that are very relevant for the next few weeks.
Well, perfectly, Scott. It sounds great. Looking forward to the journey. And, there's certainly a great deal of confusion in the markets, especially overseas. Now, people feel that the recent declines in many international markets and the surge of the U.S. dollar could make its way to our markets here in the U.S. Now, what are some of the more important events unfolding in the market, and what is the likelihood that these concerns will affect the progress in U.S. equities?
It's really coming to a point of inflection and really kind of a heading of multiple situations that are unfolding at the moment. We've seen examples of this in Greece earlier in the summer, and that's still getting resolved. These are kind of just minor symptoms of what the larger problem really is starting to kind of tell us. And there's been some pretty sharp declines in the Asian markets, and it's starting to affect some of the European markets. Now, the interesting thing about the whole argument about the U.S. dollar is where it stands on a historic basis. And I think a lot of people forget the fact that the U.S. dollar was overextended to the downside, meaning so extremely weak on a historic level that this recent rebound in many cases is only retesting the kind of average median price of the total price ranges many of the dollar pairs have faced. For example, the British pound has traded as low as 130 in the last 10 years and as high as 180, 190. We're trading around 150 right now. And the yen, which is trading about 125, that was as low as 80 just a few years ago, but as high as 220 in the 80s. So it really kind of need to keep in mind this relevant term of how strong the U.S. dollar is. Now, we are seeing signs where a new phase is starting to unfold beyond this kind of recovery phase that after the weak dollar bottomed about 6-7 years ago in 2008. Since then, we've experienced a nice historic bounce, but now we're starting to enter a new phase where we could actually see the dollar retest its historic highs across the board. So looking at the yen, euro, pound, all of these against the dollar, we are entering that next phase where the dollar is getting stronger historically and is poised to actually retest the historic all-time highs. So now we can finally say from a technical level that yes, in fact, actually there's a new character to this U.S. dollar strength, where in the next year or two, this really should begin to dominate kind of the landscape, where the dollar is improving mostly because many people feel that the Fed will start to raise rates, and being the strongest financial market in the world already, if we have a Fed that's is going to tighten and is going to be more conservative, and we're going to be fiscally more conservative, that is absolutely counter to what most governments are doing currently in the world. And if we look at China, look at Japan, look at Brazil, even the whole European Union, these easy dollar policies, easy money policies are really just a response to what the United States already has been doing for the last 5 years. But now, the United States is starting to pull it in. And the price levels, a lot of the harmonic structures, a lot of the critical harmonic measurements on daily, weekly charts in pairs such as the euro at 106 or the yen at 126 are vital. And I mean, historic breakouts where if we start to see price action in the euro versus the dollar go under 106, that's going to trigger a whole new set of support levels and actually begin to accelerate to retest the all-time low, which many don't remember, but was back in the 90s, all the way back down at the 90 level. And euro versus the dollar is about 110 right now. So we're really at that point of in many of these pairs where the technical action is beginning to dictate kind of this new phase, this next phase of strengthening dollar against most pairs, and then that probably will reach out and begin to kind of affect U.S. markets. It's going to take some time, but I think we're definitely seeing a change.
Well, that's true. So it's always a cause and effect sort of thing. You see a weak dollar, the Feds keep the interest rates low. Now with the dollar increasing in its popularity or strength, as I should say, you're going to see interest rates rise. Will we? And is there a concern for that? And where is it mainly a concern? Is it in our overall dollar of economic spending, going out to this grocery store buying bread and milk, or is it in the housing market, or where do you see that being the most affected?
Well, I think the whole interest rate backdrop is dictating the parameters of. It's really not a question of whether or not it'll happen. It's really a question of when. And many people think the Fed will raise in September. Now in my monthly report, I outlined a variety of markets where, in particular, the first couple of markets I looked at was the gold market, which is not as active as many other markets, but it has begun to break down. Really below some important technical levels, and as well as I was earlier mentioning crude oil, and I looked at the continuous contract in crude as well, and that had already broken down recently. Now it bottomed earlier this year at about $41 and then rallied back to 60, violated a very important pattern, a bullish 5-0 pattern on the daily chart that basically defined the $52 level as important resistance, and the real make or break for the whole scenario was now this psychological 50 level. So just think of crude oil below or above 50. I think that's the new norm, and I think below 50 is going to continue to accelerate to the downside. I think anything below 38 on this next retest will likely take out the lows for the year. And once we do, and if we crack 38, there's nothing but air down to $20 a barrel. And that seems like a dramatic case, but we've seen it before. It happened in the 90s, and this is really setting up where we could have this kind of acceleration to the downside. Now that correlates with things that we've seen in the gold market. I looked at the GLD in my report, and that has been on a steady decline. Now that peaked out in 2011 at about 180. Now GLD just broke the 110 level, and there was a slew of important harmonic support at about 113, 114. So now that this has not only has violated some technical support levels, harmonic support levels, it's violated a very clear uptrend line, very simple uptrend line since the 2005 low. And those kind of breakdowns always, 98% of the time, are going to give you an acceleration, continuation move, even in a small degree. And the next target for GLD, it doesn't come in till under 100. And that's, that next level is about $96.50, $97 for the spot price of gold. That says that gold's clearly going under 1,000, probably more like down to 900. Again, these are all elements and arguments of comparing them with a surging dollar, where these markets are dictating kind of, again, this new acceleration phase of the predominant trend of the last few years. So, I would pay close attention to the spot price, continuous price of light sweet crude. That contract symbol is CL, and it's traded out of New York. And that's probably the best barometer of what's really happening in the crude market itself. I had talked about the energy stocks last month and looked at the XLE as the energy ETF, that just violated some important support. So all of these signs, all of these markets are pointing to a continuation lower, not any kind of constructive bullishness that I would look at. So, and these are, these are all the big question of all of these markets and all of these signs is, will this bleed into the United States, and how is it going to impact the United States? Because we're 3+ years into an accelerated bull market, and 6 going on 7 years since the bear market low in 2009. The last markets that I addressed in my monthly report were the NASDAQ 100, the NASDAQ Composite Index. Both of these have a substantial bearish pattern on their weekly charts that have formed and completed, that are retesting their all-time highs.
And many of these stocks have jumped 10% in one day after announcing positive earning reports. That's amazing. Yeah,
really strong reports. But the problem is we've got some great moves in Google, Netflix, Amazon. Some of these have jumped 10 or 20%, adding tens of billions of dollars of market cap in a single day. And these bigger indices are really stalling out at incredibly important numbers. The NASDAQ Composite's retesting its all-time high at basically 5150, 5200, and then the NASDAQ 100 has a similar pattern. It has not broken out to all-time new highs, but it's almost there, right there at about the 4,700 level. It's 4816 is its prior exact all-time high. We're about 4,700, 4,500 area right now. But both of these, though, are in an area where I would consider them testing an important bearish structure. And I always look at these type of formations as expecting or anticipating some nominal reaction at a minimum. So I kind of have a cautionary perspective, beginning to really examine this area, this retest of these all-time highs, with these incredibly bullish moves and the really well-known names. Meanwhile, the rest of the market's not moving. Or in the biotechs, some of them have really started to fall off. So there's a bigger story here that is starting to get connected, and you can't always connect the dots directly in the market, but when multiple clear signs and markets kind of begin to flash the same scenario or the same evidence of what they, where they want to go, what are the next set of targets, or important violations of support or resistance, all can kind of tell a story that something's happening, and it's happening now. So this is what we're looking at. I think over like the next 4 weeks, maybe 2 months, we're going to see this accelerate, and the sooner we see it, we see the dollar break out strongly against the yen, or if we see the euro continue to break down, or we see crude oil slip below 38, these would be very critical signs that the acceleration is happening now. And that's what I'm looking at. I mean, these are really need to pay attention over the next several weeks here, because we are getting into that close to resolving multiple scenarios pretty much simultaneously.
Wow, so, it's interesting because 9 months to a year ago, they were talking about how gold is your best investment. Now we see that the trends of that are dropping a little bit. And crude oil, it's important in not only production, but also transportation. So if crude oil goes down, and I believe there was a 9-month report a while ago that said that it's going to continue to hover around the $2.50 mark for quite some time, and we may not see the $4.50 a gallons like we used to. So talk about that. Is that going to really impact impact the economy as a whole? Will we start to see deflation, if you will, the decrease of cost of some of these items that we purchase because of it?
That will benefit the United States ultimately, and that will translate to much lower prices at the pump. Of course, they're going to drag their feet as much as they can to not lower those prices. But this kind of scenario where you see what's unfolding in the charts and what, if we're about to violate and aggressively continue to the downside below to retest important historic lows. That's significant action that's saying, okay, this really is becoming kind of an oil crisis for them. It's fantastic for consumers, but for producers, for the energy sector as a whole, they've been through these crises before. They probably happen once every 10 years, maybe once every 20 years. At some point, this will be a fantastic buying opportunity, but I think at the moment, you've got a lot of the forces that are driving this to really want to go lower, and the way this is setting up is it could probably happen pretty quickly. I think there's nothing on the bullish side. On the production just continues to increase. If China's slowing down, global economies are having problems growing, they're going to use less oil, and we've got this Iran deal that will, either way, if they pass the deal or not, Iran gets its production.
Correct.
So you got more production coming on, historic unprecedented levels. And Saudi Arabia, there was just a report I saw a few days ago where Saudi Arabia was producing the most it's ever produced in a single month, and is not going to slow down. So this happened in the 90s, where OPEC essentially fell apart, as did the price of oil, and they won't get their act together until they're hurting so bad that they need to get along. So, but for now, you're in a situation where you've dropped from $100 to $40 in the past year, and that's had some effect on certain markets. It's now you're really starting to show up in the energy stocks, but I think this next move, and we violate again that 38 level, that probably will trigger it down to $20, and then you will see pain, and you will see major problems in the big oils as well as the explorers and the whole sector.
Well, let's touch on that as we start to wind down the podcast. What do investors need to focus on? You hit on it a little bit, but what do they need to focus on in particular over the next month or so?
So what you really want to pay attention to is how these markets that I mentioned begin to unfold over the next several weeks and into September. Especially keep your eye on crude oil. Keep your eye on the dollar, and keep your eye on the U.S. equity markets, the NASDAQ in particular. I really would be concerned if the NASDAQ stocks were unable to break out to new highs and started to roll over. I would suggest to me that a lot of this good news I've seen in Google or Netflix or Amazon might be a bit of buyer's exhaustion. Google is up nearly 200 points off its low, from 500 to 700. So incredible move so far, and people are going to take profits. That's what really I think would be the early signs of maybe a larger correction taking hold. I'm not totally convinced that it's going to happen immediately this fall, but I think we could see a setup where the dollar begins to surge, and that would be noted by, historic breakouts against the yen, or you see the euro break down under 106 against the dollar. Then I would really watch what kind of effect that a strong dollar could have on U.S. equities. And if you see that acceleration at the same time you see these NASDAQ stocks roll over, that would be a cautionary flag for me. Now, does it happen over the next 4 to 6 weeks? That's what I want to focus on. But we are kind of right in that area, entering into that zone where I want to kind of have my ears up and be on the defensive. And if I had a healthy profits in ETFs, mutual funds, I would take a hard look at my portfolio, because you got to look at the market from a historic basis, and we've come a long way in a short period of time. And this could be one of those moments where taking a little bit off the table, I think would be a smart thing to do, and then maybe looking to re-enter maybe in about a year's time or after the election, because there's certainly going to be several adjustments before we pick a new president.
All right, Scott. Well, we'll certainly be paying attention, especially as we approach the ominous September-October season that has frequently brought us troubling times for the markets, and also the presidential election, which is coming up, like you mentioned. So I thank you for spending time with us. Please join us next month when we look at the market developments from the Harmonic Trading perspective. For more information about Harmonic Trading, please visit Scott's website at Harmonic Trader. That's HARMONICTRADER, harmonictrader.com. Thanks again, and we'll see you same time next month.